and thank you for joining today's webinar, Prevent Fraud in Your Organization. I'm Megan Turco, and I will be your moderator today. Before we jump in, I'm going to briefly go over how to use our webinar console today. The orange arrow on the right of your screen will let you toggle the control tray open or closed, and at the bottom of that tray, you'll see a chat window. Please feel free to submit your questions at any time throughout the webinar via the chat function, and we'll answer questions at the end of the webinar as time permits. Also on that console, you'll see an area for your audio settings. If you're calling in through your telephone, please choose the Use Telephone option. And if you are using your computer speakers, please select the Use Mic and Speakers option. I'd also like to note that today's webinar is being recorded. We will be sending out the slides as well as a link to the on-demand recording of the webinar within 48 hours, so please keep an eye out for this email if you're interested in accessing the webinar after today or sharing it. As a reminder, to qualify for California CE credits, you must be using a personal computer, no PDAs, and log in with your own information and unique URL. Be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. Actively respond to at least 75% of the polling questions, and complete the evaluation survey at the end of today's webinar. So now I would like to introduce today's featured webinar speakers. We have Jeff Stegner, practice leader for our Forensic and Valuation Services group here at Armanino. Jeff has nearly 25 years of experience in public accounting. He's accredited in business valuation, is a certified fraud examiner, and has been retained as an expert in over 650 litigation matters. We also have Natalie McFarland with us today, who is a manager for our Forensic and Valuation Services group at Armanino. And she has more than 5 years of experience preparing business valuations and working on hundreds of litigated matters. She is a certified public accountant and accredited in business valuation as well. It's great to have you both here today, and I will pass it over to Jeff to get us started.
Thank you very much, Megan. Good morning, everyone, and thank you for joining us today. I've done, I think, dozens of these webinars now, all for credit for everybody. And in all of those, we talk about great topics, and we talk about new developments and various cases or whatever. But today we actually have, and I've never done this, we actually have a software service we can push to the listeners on the line, which I'm very excited about, something I've been waiting to do for at least 5 years now. Of course, we are issuing credit, so I have to cover certain areas. We're going to cover that before we get into the product offering we're talking about. For this webinar, we're going to talk about the characteristics of fraud and those who commit fraud. Primarily, we're relying on the most recent, I think it's 2014, Association of Certified Fraud Examiners statistics. You're going to hear a lot of percentages and numbers we're going to throw out at you. We'll talk about the key prevention techniques recommended by our firm as well as the ACFE, areas that you can use in your company. Hopefully you're going to learn a few things here that you can take back and implement immediately or shortly thereafter. And I get to tell a few stories. Not too many stories today, as Natalie tells me, but I do get to cover a few stories of engagements I've investigated or we've investigated recently that can show how scary some of these things can be. We're going to cover the types of fraud. First of all, I cover the fraud triangle. I show this picture in every fraud webinar I do. Actually at one this weekend in New Orleans at a national conference, and they had their pretty triangle up there as well. We'll talk about that. There's 3 different types of fraud we'll cover: asset misappropriation, corruption, and financial statement fraud, what each one of those are, as well as the types of fraud that is implemented against each one. We'll talk about, as I said, according to the most recent ACFE study, the ways that people discover fraud, the types of businesses that are targeted, and some red flags you can look out for with your employees or coworkers. We'll cover a lot of those in our upcoming slides. And then very valuable to everybody on the line, at least it should be, are ways to prevent fraud, various techniques that we recommend. And I'm not sure that we have a checklist here. We do have a checklist. I've shown it in other webinars, and if anybody needs one, I'd be happy to send it to you. But most importantly today, we are covering specific techniques you can implement to protect your organization against fraud.
Okay, so a lot of people know that fraud is bad for a company's bottom line, but one of the things we really want to stress today is how deep fraud can not just affect the financials of a company, but the employees. So today when we talk about preventing fraud and detecting fraud, we're not just talking about protecting the financials, we're talking about protecting yourself and the employees. Fraud is actually one of the leading causes for businesses to fail. This can be because the financial damage is so great the company can't recover. It could also just be because the company can't recover from a damaged reputation. There are definitely a lot of smaller scale frauds, so it may not be big enough to bring down the company, but what we've seen time and time again is a trusted employee that's committing fraud, and that creates a lot of hurt and betrayal, morale falls, and it just creates a stressful environment. So as we talk about this, I really want to stress that this is not a witch hunt for employees. I think a lot of times when fraud is discussed in a company setting, it's the higher-ups out to get the employees. That is not what we're talking about at all. This is to protect employees as well as the company's financials. So I'm going to pass it back to Jeff to give a little bit of an overview of fraud and its landscape today.
And one thing I wanted to point out on protecting the company itself, I believe we have some nonprofit organizations that are on the line here, and every year we run a fraud seminar for nonprofit organizations. And if a nonprofit organization gets hit with fraud, it can be devastating to that organization. The public loses trust, and donations cease to come in or become much harder to come across. And that is a bad outcome for nonprofits. And unfortunately, I've investigated numerous frauds related to those types of organizations because of a weakness in controls that they have. And it never is a good result, no matter what the loss is. So here's my fraud triangle. I talk about this at every fraud webinar, and because it's a good graphic. And every fraud has these characteristics that come about. Pressure. Someone feels a financial pressure, the fraudster feels some sort of financial pressure that they can't share with anybody else. So it's unshared financial need is what it comes down to. The rationalization, why do they deserve to do this? It's unfair, I deserve better, I'm not being paid enough, I need the money, I'll pay it back. Those are all good rationalizations for this to occur. But the main thing, everyone here on the line, I believe, should have an understanding of accounting and work in an accounting department or be associated with an accounting department. The one thing that financial professionals can do is limit the opportunities. Every fraud I've ever investigated, when I look back on it, there was an opportunity that was exploited by the fraudster. It's shocking to me how obvious these risks and these control weaknesses are when I come back after the fraud has been discovered. Before the key here, though, is to limit those opportunities and determine ways to stop the fraud from occurring as opposed to letting the cows out and then shutting the barn door. I was at actually the seminar I was at this weekend, took this triangle and put a cloud over it, which I thought was kind of cool because that sets the tone at the top. If organizations aren't concerned about fraud, or if management sets a bad ethical standard, that tone can create more opportunities, can allow for rationalization that opens the door for more frauds to occur. So this is where I get to tell a couple stories, short stories. But there are three types of fraud, as I mentioned earlier. I'm going to explain each one. We'll start out with asset misappropriation, which is the most common type of fraud that exists. We'll see in a graphic in a moment on that. But this is where individuals or groups of individuals convert company assets for their own personal use. Basically, you're stealing money, you're stealing inventory from the business. Most of the investigations that I've done have covered this area. Asset misappropriation can come in through stealing inventory out the back door, skimming collections from receipts, or by companies simply writing checks to the fraudster, which is a couple of ones I'm going to talk about here. The most recent investigation we did was an executive executive administrative assistant, easy for me to say, who was in charge of purchasing various items for their group. And this individual was given a company credit card that actually was a she. Most of these are men. I think now I talk about the characteristics, it's mainly men, but a couple of my stories here today involve women, so it's minority, I'm sure. But she was given a company credit card that she could use to purchase goods for the company. But she was abusing it by creating false invoices, and this is a risk we have in this electronic age. She was buying goods at a local retail establishment, reporting them as goods for the business, but actually she was faking the receipts by creating a fairly complex invoice. You couldn't tell by looking at the invoice how incorrect it actually was, and purchasing gift cards, I think it was primarily, and other personal goods with the company credit card, and then submitting a fake invoice. And she had gotten away with it for, I believe, 4 or 5 years. I believe they're investigating right now, law enforcement prosecuting against her after she had been terminated. But that's an example, false invoices that are submitted for reimbursement. The other story I have, really quickly, is an individual that was in charge of accounts payable and decided that he didn't want to work early in the morning. He wanted to stay later so he could be away from people when he was working, so he could work harder, is what he said. And what he was really doing is stealing the signature stamp from his boss and stamping checks approved to pay to himself out of a very little used account that nobody else had bothered to reconcile. And he got away with that for, I think, our best estimates are 5 to 10 years he had gotten away with it, where nobody was properly reconciling the account. So those are 2 examples of asset misappropriation. Corruption is where someone, usually it's a collusion between an employee and a vendor or a contractor, where they get special treatment or kickbacks for swinging the business toward that supplier or vendor. I can't say that I've actually investigated this sort of situation. Certainly read plenty of stories about it, and they can be fairly substantial frauds when they're committed, as they take a little bit of collusion. The asset misappropriation can obviously be implemented by one single individual, and the loss is a little bit lower. You'll see in just a minute here. Corruption actually is more prevalent, according to the ACFE, outside of the United States than it is inside the U.S. The United States has stricter rules against graft and corruption than outside of the U.S. So it's more higher incidence and higher dollars outside the U.S. than in the U.S. The final one up here is financial statement fraud, which are the huge headlines, Enron, Madoff. Those are huge scandals. The whole mortgage securities issue were financial statement frauds. They were massive scale. When you get companies or boards or the C-level executives all working together, you can manipulate stock price, and the losses are just huge. You'll see that in a second as well. These are the frauds, and you'll see a surprising statistic at the end of this presentation that shows financial statement audits and how effective they are on finding fraud. Financial statement audits, which are something that a lot of companies have, I think 80% of companies have some sort of financial reporting. Those are designed to protect against financial statement fraud, which you'll see is significant in dollars, but not in very much in occurrence. So here's the graph I talked about as far as occurrence and asset misappropriation. You can see 85% of the frauds reported, and this doesn't add to 100, just in case anybody's freaked out by that, because there's 2 different factors that can be, more than one type of fraud can be implemented for the occurrences that we're covering here. But in 85% of the cases, it's some sort of asset misappropriation, and that's most of the frauds I've investigated have been in that area. Again, it takes one person that can do that, and most of the frauds I've investigated have been perpetrated by a single individual. Corruption takes usually more than one person to be involved. I've had a couple of those, usually involving some sort of overstatement of profits or sales for the benefit of a few individuals. And then financial statement fraud, fortunately, doesn't occur very often. But you'll see the next slide why that's a good thing, because the average loss is huge for financial statement fraud. And this is actually down from, I think this is the 2014 study. The 2010 study, just before the complete implementation of Sarbanes-Oxley, and basically the follow-up of all the investigations, the average loss in the 2010 study for financial statement fraud was about 4.1 million. So it's come down quite a bit in this study. The losses for asset misappropriation and corruption, that's about the median loss I've investigated, somewhere in that range over the last few years, which, obviously pales in comparison to financial statement fraud. But for a lot of organizations, a couple $100,000 walking out the door is not beneficial, or can lead to poor morale, and in the case of a nonprofit, can lead to reduced donations if they believe they can't trust where their contributions are going. And now it's time for our first polling question.
Thanks, Jeff. So on your screen, you'll see our first polling question. Our question today is, which of these is not part of the fraud risk triangle? So please select one answer from rationalization, opportunity, trust, or pressure. We'll give everyone a few moments here to answer the question. And just for a reminder for anyone looking for those CE credits, you do need to answer at least 75% of our polls today, or I'm sorry, respond to at least 75% of our polls today in order to get those CE credits. So it looks like we have just about everyone responded. So we will go ahead and close the poll in 3, 2, 1. And I will pass it back to Jeff to discuss the answer.
And everyone was paying attention, or virtually everyone was paying attention, 88% of the people. Because trust is, in fact, the correct answer. Trust is not part of the fraud triangle. But as I always say, I think it was my audit professor in college told me, or told the class, that people you don't trust can't steal from you. It's the people you do trust. And in every instance, I can't tell you how many times I've heard the story, but they were my favorite employee, or they've been here forever. We could trust them with anything. I never expected someone like this could implement this type of fraud, but it's always seems like the hardest working, most dedicated employee can fall into the trap of committing fraud. Now it's over to Natalie.
Okay, thanks, Jeff. So we're going to talk about prevention and detection techniques, but first I want to spend a little bit of time talking about who exactly it is that we're talking about today. I think there are a lot of misconceptions out there about who commits fraud. It sounds like a criminal activity because it is a criminal activity, but a lot of times the people who are committing fraud don't seem to have a criminal, like Jeff said, you wouldn't expect it from them. It's the least expected person. So one statistic I like is that 82% of all fraudsters are actually first-time offenders. So this isn't going to show up on a background check, and oftentimes it's not even something the perpetrator knows about themselves until it's too late. We see a lot of times people just get caught up in an opportunity and they just go way too far down the path, but they themselves would never have suspected that they would have even committed fraud in the first place. So although employees do the most fraud in terms of occurrence, it's 40% of lower level occurrences, they had the lowest median loss per event, so about $100,000 for lower level employees. On the opposite end of the scale, executives' losses averaged about $500,000, which is down from 2008, which was closer to $1 million, so that's good, but the higher up someone is in the company, the more they have access to information and opportunity to commit fraud, that crucial piece of the triangle. So you'll see higher losses with higher level individuals. The average perpetrator, as Jeff said, was a male 36 to 45 years of age. This is an extremely simplified statistic. We definitely have plenty of examples of both genders, all ages, so you really can't look at a specific type of person. It really runs the gamut. That's just the statistic that was reported in the survey. Most occurrence of loss occurs between 1 and 5 years. So usually employees are there to gain trust of their managers. They gain a little bit more responsibility, and they have access to a few more pieces of the job that allow them to commit fraud. The median loss for employees of 1 to 5 years, again, is a fraction of those with 10 plus years of experience. The story Jeff told earlier about doctoring invoices and receipts, that employee had been there for well over 10 years, which caused that fraud loss to be a lot higher than it could have been, but it also was what caused so much trust in the employee. So just because someone's been around a long time doesn't mean that this couldn't be happening behind the scenes.
And I have to say that the longer an employee has been there, usually the higher the loss. They've gained more trust, they have more leverage, they know more about the systems, and therefore the losses can be greater. The same thing with a level of authority. The higher the authority, the larger the loss can be. It's all about leverage, and if you get more than one employee in, then the losses go up exponentially.
Okay, so where is this occurring? It is not surprising at all that accounting departments had the highest losses and occurrences. Apparently you just can't trust us accountants. But really, no, that's for obvious reasons. They have the most knowledge about the financial workings of the company. They have the most access to information. And a lot of times in smaller companies, there just aren't enough people to segregate duties the way that it would be ideal in a company. So if you have too few people doing too many jobs, especially in the accounting department, that can be a big problem. A couple things to look out for specifically in that department. Probably the easiest thing to spot is if they're behind on creating reports. So if bank reconciliations aren't getting done, month-end financials just don't seem to come around as quickly as they should, that's definitely something to be watching out for when it comes to the accounting department.
And the investigation I talked about earlier, this individual that was submitting her expense reports was always the last one on the list to get her expense reports in. The person collecting reports was constantly chasing her down to get the reports. Why? Because she had to create them herself, to get them to balance and make sure that the charge matched what was on the credit card. So that was a red flag. In nonprofit organizations, if the financial person can't get their books closed quickly enough, that is a red flag.
Definitely. Okay, so behaviors to look out for. An employee who doesn't take a vacation is a huge sign that something might be up. We all love our vacations, even if they're just staycations. So if someone is purposefully avoiding their vacation, that is definitely a red flag. That's because they want to be on the job. They don't want anyone to take over their responsibilities or see anything that they could have been doing over the past few months, years, etc. If they're very possessive of their work, this can be a problem in a couple of ways. The first, similar to the vacations, they want to keep the work for themselves. They want to hide whatever it is they're doing and not have anyone else come in and take over their responsibilities. The other thing that can happen is if they have a lot of work on their plate, they can use that to rationalize, quote, extra compensation, even if they're compensating themselves. All the extra work makes them feel like they deserve the extra funds coming in. Another thing to look out for if they are really close with vendors or customers, like Jeff said, this isn't as common in the U.S., but it's also a red flag. A lot of times if they're going out together or they have a especially close relationship, there could be something going on about why you're using them as a vendor or what their prices might be. The thing we probably stress the most in terms of behavior is if they're living beyond their means. So they might be going on lavish vacations, they might have fancy cars. You might say, hey, I can't even afford a car like that, and they're 3 levels below me. That could be definitely a red flag. There was one client that said their employee inherited a bunch of money from her parents, or that's what she said.
This was a he, actually.
Oh, I'm sorry.
It was not a woman that pointed this. So I want to point this out.
But through a mutual acquaintance, it was actually found that, nope, there is absolutely no way they could have inherited anything from the parents, and they were really just pulling money from the company instead and using the inheritance as a cover.
And I think one of the ones we had recently was the one that turned herself, she actually turned herself in, is she came up with some story. Again, it was a she. she had said that her husband had been contacted by the FBI or something, and that's why she felt she had to come forward and talk about the loss that she had put forth in the company. But her representation was, well, I paid it all back. This gets back to the rationalization. I'm just going to borrow it for a little bit, but I'll make sure I pay it all back, and they don't pay it back. I think one statistic we didn't talk about in here, I believe it's at least 50% of all frauds investigated have no financial recovery, not one penny. And I believe 100% of them don't get it all back. So now we talk about a few prevention techniques. This is where you get to pitch the hotline, as you see we put up here. Far and away, the most efficient and effective method of preventing fraud is a hotline. Natalie talked quite a bit about employees being fearful of being caught. And they try and, they're excessively controlling over their work. They don't take vacations. They don't want to be caught by anybody. If a hotline is in place where they believe that anyone they sit near or know at the company could potentially turn them in, that increases the fear level and hopefully reduces the risk of fraud. The company's not cracking down on a single employee. All they're doing is setting the tone at the top, indicating that the company will not put up with this, and that everyone in the company is watching out for some sort of fraud. The hotline can be, it's anonymous is another good thing, so it gives a feature for somebody who doesn't want to turn in their cubicle mate, but can report it anonymously without having to testify or get whistleblower fees if they are turning somebody else in. The cost to do this is extremely low. As I said, the publication of it and notifying everyone is extremely effective and for very, very low cost. Segregation of duties, now they talked about this. We have, in one of the instances, we had one, again, it was a woman, I apologize for this, where she was in charge of doing collections. There was a third party that was out collecting on bad debts at I believe it was an insurance company or a DMV, I think it was. She was out at the location collecting bad debts, and she was controlling the cash, depositing the cash, and keeping a percentage of it for herself. So the duties weren't segregated. In the nonprofit arena or very small companies, segregation of duties can be very expensive, and that's where the biggest risk comes in, where duties aren't segregated. Usually one person should be, collecting the receipts, another one paying the bills and reconciling the bank account. So you can't have one person in charge of too many duties. Job rotation is another way to go around it. If you can't have two employees to take care of some accounting function, at least you can have one person rotate through either in different organizations or different locations to come back and rotate through. So these long-term frauds we talked about, 5-10 years being perpetrated by them maintaining their systems, can't be replicated because you've got new people coming in on a regular basis. Management review, obviously all management should be reviewing the financial controls and reports, but this is kind of the last line of defense, not necessarily specific targets, but if cost of sales look out of whack, or if bank reconciliations aren't being done properly, these types of things management should be on top of. Most typically, fraudsters and investigations that we've had, they target areas they don't believe management or the auditors will look at. Taking money out of either expense reimbursements was this one we talked about earlier, or I had another one that was the biggest vendor of the company. They were replicating, putting their name in as opposed to the name of the vendor that was supposed to be being paid. So it was very difficult to see a fluctuation that the dollars didn't amount to very much, and therefore it wasn't found. Other ways to do a little more involved prevention techniques. I talked about tone at the top. I'll reiterate that a few more times, I'm sure, before we're done here. But having a highly ethical management level sets the tone for everybody else in the organization. If management is a good example would be the Wolf of Wall Street came out last year, and that was a good example of the executive level did not have a high ethical quality, we'll put it that way. And that kind of ran through the entire organization. Fraud assessments are a service that can be brought in outside of preparing financial statements, an internal control review is done. In case companies don't have internal control or financial statements being prepared, this is a way that an outside consultant can come in and determine if controls are being properly implemented, or at least as management understand them, are being properly implemented. So you're having a discussion to see what controls could exist without necessarily testing all the controls. Surprise audits are a way that those companies that have internal audit departments coming in and auditing a certain location, a retail store, someone else come from internal audit coming in to surprise and do a cash collection reconciliation, or reconcile bank accounts or sales reports without anybody at just some random time. That not only do people that deters fraud by people not knowing when this could come up, without somebody having to implement a control that comes in place, say, every day or every month. Do not rely on external audits as a primary detection method. I don't know if we have the statistic. I think we are going to show it in a minute here, where the frauds discovered by external audits are actually extremely low as far as the number of occurrences. We saw the financial statement frauds are very low occurrence overall, and those are the frauds that audits are designed to find, not these small $100,000 to $200,000 losses that a company with $50 million in sales, that's irrelevant. It's not material to them, but it is material to the individual and sets a bad tone for the company as well. And then one way, of course, is to implement fraud training for all. What we'll talk about in a minute is how the hotline service that we offer does include a discussion, basically this webinar, for all employees of the company to talk about the things to watch out for in fraud. So everyone is aware. If they're, it increases the eyes of management over the rest of the employees, and if a hotline is available, they can have an outlet to report such a fraudulent activity. We talked about the highly ethical culture, and this is where management sets out and they try to do the right thing and sets that tone for the entire organization. One of my favorite saying is the fish rots from the head down. Just think of the movie last year, and if the main character or the main executive in the company is not following ethical behaviors, then the chance the rest of the company will is much lower. Let's put it that way. Communicate methods of discipline. If with the last investigation we had, the entire company was aware that the individual was not only terminated but will be prosecuted. That's kind of an unfortunate way. Hopefully that that will likely deter others by believing that management is stepping in on time, but setting a more positive tone, in my opinion, is a better way to do it, by saying, hey, look, we're all aware of this and we want to make sure everyone else is as well. Polling question 2.
So shortly we'll have our next polling question up on your screen. And this one is, which prevention techniques are you currently using? And please definitely select any of them that your organization is using. From an external audit, internal audit, hotline, management review, or anything else that maybe isn't already listed in this list here. So it looks like we have about 60 people, or 60% of our audience here voted, so we'll give everyone else a few more moments. And we are almost there. It looks like we are just about done, so we will close the poll in 3, 2, 1. And I will pass it back over to Jeff to discuss those answers.
Thank you, Megan. And we see from the audience here that management review is the #1 technique being employed, and that actually should be employed by all companies. But that should not be the only control. External audit is the next highest one, which this group has got 65% that answer to this. I think overall in the ACFE study, it was like 80% of companies had external audits as their main focus of control. And unfortunately, the lowest technique being used here is the hotline. And I believe that's exactly the percentage that privately held companies use, as far as using hotlines as as a source of fraud prevention. Publicly traded companies or companies that are about to go public, because of the Sarbanes-Oxley Act, have to have hotlines in place, but private companies don't. And unfortunately, as this study shows, 19% of the people on this call, as well as about 19% of the overall public, as I recall, or companies, privately held companies, had hotlines in place. And as we'll talk about in a few minutes here, how inexpensive and effective a hotline can be. But I want to turn it back to Natalie to discuss this further.
Yeah, so we're going to jump off of that poll because it really ties perfectly with what we're going to talk about next. So when detecting fraud, the most common way fraud is detected is through tips, internal tips. It's about 43% of all frauds are initially discovered through a tip or a tip line. And this is a very, very high number considering the survey actually has over 10 different detection methods listed. So out of over 10 methods, 42% of them are tips. That's huge. A number of frauds we investigate over the years do initially start from tips. External audits, on the other hand, only find 3% of fraud, and fraud discovered by accident is actually 7%. So our audit department really doesn't like that statistic. External audits are still very important because they're looking for material fraud, and as we discussed earlier, the financial statement fraud is definitely the highest in amount, so the external audits are definitely absolutely worthwhile, but the smaller frauds that are occurring the most often, around $100,000, aren't going to be detected by those external audits. That's where the 40% from a tip line really comes in. This has a profound effect on how the prevention of fraud should be addressed. As we keep saying, it's the tone at the top, allowing for free communication. As management of a company, you want your employees to feel like they have a safe place to let you know if they see anything going on. The next highest way to detect fraud is through management review or internal audit. Both of these are about 15%. So it's a far cry from the 43%, but it's still a good number. So here's a really good visual of what we're talking about. So as you can see, of all these different ways to find the fraud occurring, tips are they just far outnumber any other method of detecting fraud. So we really want you to take advantage of this information. Hopefully we've got a really good system in place that not only do tips find fraud more frequently, but they find it faster. And the faster you find out a fraud is occurring, the less loss you've incurred. Because as Jeff said, only 50% is recovered. So the faster you has any recovery, I apologize. 50% has no recovery at all. So the faster you find it, the less of a loss that occurs. So the initial, like I said, the initial detection is definitely the most critical point. You want to find it immediately, investigate it immediately. And the best way to do that is through tips. So just like our survey, which is crazy, 18% of organizations with less than 100 employees had hotlines. So this falls directly in line, and our goal is to really have a minimal cost solution to this and to catch fraud quickly and frequently.
And what we're trying to do is increase the likelihood that tips come forward. As you can see, that's the most common way to find fraud, and making it easy for people to come to tips. Obviously, if the president's sitting in his office and the fraudster is sitting right outside, you don't want to walk in and talk to somebody about it. But encouraging employees to give tips is the far and away, as we can see, the most efficient way to catch fraud. And the hotline, as we have depicted here, is the easiest way to do that. And it's not just a hotline; it's a phone number as well as a website.
Right, exactly. I mean, it could even be the CFO committing something, and a lower level employee isn't going to walk, and I mean, they would have no one to talk to. So this allows some
anonymity.
Anonymity.
Easy
yes.
for you to say.
Okay, so I know we're throwing a lot of statistics out at you, but the numbers are they speak for themselves. 5% of revenue is lost every year to fraud. That's a huge number. That's the estimate that's out there. Organizations with hotlines saw a significant change in their landscape. loss was much less. And just having the hotline in place deterred people from committing the fraud in the first place. Jeff talked about that a little bit earlier. Just having the posters in the break room let people know that someone else could be watching them other than management, and it really protects them from themselves. If they never committed in the first place, then they get to keep their jobs, the company's happy, the employees are happier, everything just goes better, just from a poster.
The poster, or the other thing I will be recommending is that now that we're in the internet age, most companies have intranets, and a link can be put into those as well in order to encourage reporting. But I just want to focus on the top statistic here. I think we had a question about this as well, is what is the estimate of fraud or unreported fraud that goes on. If you think about 5% of revenue, that's top line, any company that couldn't do with 5% more revenue, or 5% of revenue dropping to the bottom line, I don't know any businesses that wouldn't be very excited to have that. And but that's a global number for the amount of fraud that's committed. It's an estimate, obviously, but a global number of what the Association of Certified Fraud Examiners estimates is the annual loss to fraud, and it's pretty consistent over the last the last 12 years they've been running the survey. That number hasn't changed much, 5% of all revenue. We'll run to another polling question.
So our next polling question is actually true or false. External audits are a thorough way to detect fraud. True, false, or not sure, of course. Those ones are pretty easy question there. So just as one final reminder, this is actually your third poll question, so you have one more, but you do need to respond to 75% of our polls today if you are looking for those CE credits. So we will give everyone just a few more seconds here. We've got just about everyone responded, so we'll close the poll in 3, 2, 1.
And everyone appears to have been paying attention, because 93% of you said that false. And as I pointed out earlier, I want to make sure I qualify this. We have an excellent audit department in our firm, and I'm a former auditor as well. Financial statement audits are designed to prevent financial statement fraud. And we saw that the numbers we saw are 3% of audits are found through financial statement audits. That's a number. There's numbers of events. 3% of frauds detected are found that way. And we looked at the earlier statistic that said only 9% of all occurrences relate to financial statement fraud. So it's a pretty good percentage of the numbers of financial statement frauds that are prevented by or detected through financial statement audits. What's not detected are the most common types that are realistically immaterial to the financial statements of the company. Like I said, if you have a company with 10, 20, 30, 40 million of revenue, a $100,000 loss is simply not material to a financial statement fraud audit. So those are the losses that occur most often, and are the ones that we get investigated to detect on a regular basis, and also the ones that a simple hotline can hopefully prevent or discourage at a minimum. So this is the slide that I am extremely excited to present to everybody. We have been looking for years to find a service that we can recommend, because hotlines have been the most effective, most cost-effective, and most effective overall method for encouraging tips and reporting frauds. I've been talking about it for at least 5 years now that we've been going over these ACFE studies, and we've been looking for partners to be able to recommend to people, to our listeners here as well as our clients. Well, we finally found a partner that Armanino can partner up with to offer this service to our clients, and it's red flag reporting. We are the implementer, but the software is run by this organization. We being Natalie mostly, looked at a number of different vendors, and Red Flag was clearly the one that we thought was the best fit for us. Their differentiator is it's an excellent piece of software that is run over the internet, as well as all reports come to a CPA and CFE. So I will get, Natalie or I will get reports whenever something is filed. We get an email and a text message almost immediately, and one of us contacts management. We contact either, we usually get a minimum of 2 names that we would contact, usually the president or major shareholder and a top accounting person. Obviously, we want 2 in case the top accounting person is the one committing the fraud, or the president is, and we want the CFO would have to report it to the audit committee or to the board of directors. So, and that's what we do. We report it. We don't necessarily investigate it. We obviously can be retained to investigate it, but the main thing is we want to report it, and that is hopefully encourages tips and discourages fraud is what we're looking for. The service is 100% anonymous. If someone does not want to disclose their name, they don't have to. The process is run. We have a couple slides we're going to run through. There is an option that anyone can do if they log in to report their name or remain anonymous, and the reporting goes back and forth until the investigation can be underway. Toll-free number, it's 24/7. Obviously the internet is up all the time, but also there is a call center that Red Flag operates that has multiple languages and is in operation 24 hours a day, 7 days a week to take the information. What the operators do is just basically key it into the website, and that triggers the software coming to myself and Natalie to respond to the information. The reporting is done usually within 24 hours, 24 hours a day, 7 days a week. So we get it all the time. So as we said, the key benefits, hopefully we've hit this enough. It is the #1 way to detect fraud through tips and through communication. It sets a strong tone at the top, and it reduces damages from fraud by 60% to decrease the occurrence and shorten the time. Those are the 2 most important factors, I think, in having losses from fraud for organizations. So here's what this pretty red that we like indicate a red flag. This is on the website. All you do is simply click a button, and it starts to walk through a very intuitive screen on how to run a report or file a report. When we give this presentation to anyone who implements this service, we have kind of a working demo. We walk through this stuff in much more depth than we're going to today, but it is extremely interactive and easy to use. So this is the next flag. Once you want to file a report, this is the next screen that pops up. The client code is what's on each client this service has a specific client code. That code number is in cards that we hand out, or that can be purchased if there's more that are needed, as well as on all the posters that would go up, and should be on, if it's going to be connected to the company's website internally, then it would be listed there as well. Organization name is put in, and where the location is. That starts the process. Let's go to the next slide. You can talk about, you can identify the type of fraud that you believe is occurring. Obviously, employee management. I think these are pretty self-explanatory, but it's simply the category that gets reported onto the next screen. Then once you get past that screen and start to implement the date that it occurs, or you believe it's occurring, or if it's ongoing, the individual that may be involved, a description of the activity. I believe there was also, I think one example that they showed us is you can upload pictures of people. I think the one they showed was an employee filling up their car at the company gas station that wasn't supposed to be done, and that picture was uploaded and sent in. All that information is then submitted once a report's filed, comes to us as an independent third party, and that we can then figure out who the appropriate person is to forward it on, and then make the report to management. And remember, this is just simply a reporting function only. This is not a continued investigation, but getting the tip is the first step. Once that's done, management can decide how they want to next proceed. Mm-hmm. So what we can do now, if this is interesting to anybody, you can just simply let us know. Our contact information will be coming up shortly. But what you get with the hotline service is a presentation of the company, either through a live presentation or through a webinar. would go for about an hour, just like we're doing here. A few different slides we'll put in, but identify the characteristics of fraud as well as how to implement how to report on the hotline. It's easy to implement because it's all online. Simply all the company needs is to get the information their company signed up, and the software is all ready to go, and it's inexpensive. We talk about segregation of duties where you need more employees. We talk about job rotation that causes time for people to move from one job to the next. These are all more expensive than this simple report, which is the annual recurring fee is for most companies about $1,500. Very small companies would be a little bit less. Large companies it might be a little bit more. But for an average company, it's going to be about $1,500 as an annual renewal subscription service, with a one-time setup fee to include our presentations and the collateral that goes along with it of about one-time annual fee. Time for our last polling question, I believe.
Yeah, this will be our last one. So here up on your screen after today's webinar, we were curious to know, would you be interested in a fraud hotline service? And of course, pretty simple answers there. So just go ahead and let us know if you would be interested. And of course, as Jeff mentioned, this is our last polling question. And even if you're not interested in those CE credits, we are definitely still interested to hear your thoughts. So it looks like we have actually just about almost everyone answered. So we will close the poll here in about 3, 2, 1. And I will pass it back to Jeff for the conclusion.
All right, thank you for your responses. I believe we've covered our topics today. We do not have the checklist in there, so if anybody is interested, I think there's a question here about the slide deck, and we will be sending out, if you're interested, this webinar is being taped and it's on our website. If you want the slide deck and a PDF, it'll either be sent to you or ask us and we'll definitely send it to you for your future reference. We talked about the types of fraud committed. We kind of stratified the based on percentages, the number of occurrences, and the dollars that are lost. We've talked about the red flags to look for with employees or with companies on who can commit fraud, as well as what types of methods can be implemented to try and prevent fraud in your organization. I think we're going to flip now to any questions that you may have. Please submit them. We have a few that are listed in here. We'll be covering those in a minute. And we're also going to, if we go one more slide, I think our contact information is in there. If you have any questions, you want to reach us later, our information is here. We're very easy to contact, and we'll get right back to you. But Megan, do we have a few questions?
We certainly do. And as Jeff mentioned, you are still welcome to submit your questions. If there are any that we don't get to today, we can definitely follow up and answer after the fact. So our first question, if the fraud hotline is alerted of potential fraudulent activity by an employee, how is that employee managed until the fraud is fully investigated?
And that's really up to management. As I mentioned, this is a reporting service. So what Natalie and I do is we notify management of what's happening. Management ultimately decides how they want to best implement it. If whether it's bringing the employee in, gathering information, conducting their internal investigation, or conducting an external investigation. That's really how the company decides to respond. Obviously, Natalie and I have our opinions on how best to deal with situations as well, and we'll consult with management when we make the report initially, and then management gets to decide how best to deal with the situation.
Well, thanks, Jeff. Our next question is, how long does a fraud examination usually take?
I can speak to my experience, and it depends. Obviously, it depends on the investigation and how extensive it is, or how easy it is to obtain records. But I would say the average investigation, I believe, has taken a month or two, with most of the activity happening right at the front end. As soon as a fraud is investigated, we try to jump on it immediately to figure out how extensive it can be, and then the next step is to start pulling records and interviewing employees to see where else it could be. What we do In a number of instances, we will be brought in at the request of the company to file a claim with either their insurance company or file a claim with the police department. And the sooner we get that wrapped up, the better. But I think most of our investigations have been over a month or two to gather information and then issue a report.
So our next question here is, does the whistleblower, the person who's reporting the fraud, does that person get a reward through the red flag program?
Again, that's not really up to us to decide whether a whistleblower should be compensated or not, but it's up to management to decide that. It's interesting that in talking to our partner at Red Flag, he had indicated, and I think this bears out in the ACFE studies as well, that people that are reporting frauds most often don't do it for financial rewards for themselves. They do it because they care about the company and they think it's the right thing to do. I think it's, as I recall, something like 80% of people aren't reporting fraud for the whistleblower reward. They're doing it simply because they believe it's the right thing to do. So as far as paying out a reward, again, it's really up to the management to decide how they want to approach it. We're simply reporting the information.
So Jeff, I know you mentioned earlier you had some stories that Natalie wasn't necessarily letting you share, but if you did have any other ones, any other really good examples, do you have any other examples that maybe we didn't cover today that would be really good for some of our audience to hear?
As a matter of fact, I do. One thing we talked an awful lot about internal controls that need to be in place, and how we talk about a financial statement audit will go out and talk about internal controls and figure out what controls management believes are being implemented. We have a whole group in our Sarbanes-Oxley compliance, I guess it's governance, risk, and compliance group, that goes out and finds out what kind of controls are in place and then tests those controls. One of the frauds I didn't talk about was just a flat-out management override of the controls. There was a homeowners association, and it was a woman again. Seriously, it is not more all women that I've investigated, but it was a long-time employee that had been at a management company that was offered to homeowners associations to run their accounting systems. Typically, with homeowners associations, it's a group of owners that come in and run their association, and there's turnover. And if they don't want to deal with the day-to-day paying bills and making sure that inspections are done and repairs are being made, they'll outsource that. Well, this management company had a key employee that had been there longer than anybody else, and was in charge of, I can't remember, 10 or 15 different associations that she was in charge of paying the bills, issuing the financial statements, reconciling bank accounts, everything for these associations. And for several of the associations, she had been there long enough, they trusted her to be signatories on their bank accounts. Bad idea. As well as making herself when she became the signatory, she could override the controls of having more than one person sign. She could sign for herself, and she was taking a little bit of funds from a number of different associations, and as well as using her personal credit card and being reimbursed for purchases at fraudulent locations or for her personal benefit. So it was an investigation that we were brought in by one of the associations that was hit. The management of the company obviously terminated the woman immediately, but then I'll cover the cost of any investigations the associations wanted to incur on their own, which I thought was obviously the right thing for the company to do, and they did cover our costs to investigate. I believe we found more problems than they had originally discovered in their analysis, and they covered that and made it whole for the associations. But that woman actually was not prosecuted, and during the course of my investigation, I found out that she was actually employed at another management company doing the same exact job that she was doing at the first company. She obviously didn't have the tenure or the ability to override controls, hopefully, and which limited her ability and opportunity to commit fraud. I believe we have one more minute here. If there's any questions, please send them through. If not, I believe we've met our requirements. So thank you very much for joining us. We'll leave it open for just a minute to see if another question comes up. But if not, thank you for tuning in this morning.
And just as we mentioned, if you guys do have any specific questions that we don't get to in this last minute here, definitely feel free to contact Jeff or Natalie directly. Of course, their contact information is up on the screen here. And as we do exit today, there will be a quick survey. Please take a moment to let us know your thoughts on today's webinar. Thank you, Jeff and Natalie, as our expert speakers here. And thank you to everyone who's on the line, and have a great rest of your day.
Thank you. Thank you.